It's not interested in real production. And there's a mental shift here, too. You could argue that the capitalists just want to get rich quick. They don't really want to do the hard work of producing things anymore. Henry Ford isn't your hero. Your hero is Gordon Gekko or whoever it might be, Ivan Besky or some financial speculator. And indeed, they show, this is a typical kind of chart from these arguments. Here's the origin of U.S. corporate profits from 1950. This is in manufacturing, is the dark line, and the share of profits plunging, and here's the share of profit in finance going up. But here, by combining these two graphs, not just showing the financial graph, but showing this, you're making an argument about something is fundamentally screwed here. And we've talked a lot about, is U.S. manufacturing declining? Is the U.S. in trouble in a world kind of historical way? And these people would back that kind of argument, that the shift into finance and financialization is a sign of the sickness, every bit as much as invading countries for no reason. And indeed, if you look at the record of the neoliberal period, since the U.S. started running into global competitive trouble, we've had one damn thing after another, as they say in history. You get the bank and international debt bubble of the 70s, the S&L and stock bubbles of the 80s. I'm going to go through these, by the way, just to bore you to death. The 90s stock bubble, although this isn't that boring, frankly. And then the 2000s we'll get the mortgage bubble. So like and it'll get worse as I break this out. But to give you the big pattern, every 10 years we're having a major boom and bust and a bubblish thing. And every bubble got worse. It just got bubblier and bubblier. This is just the S&P 500, but you can see it just gets kind of, by the time you get to the 90s and the 2000s, you're just in deep doo-doo here. But this is so out of proportion to the past. And look at the golden age when nothing's happening here. So something's going on here. And whether you call it financialization or froth or whatever, or the long 20th century or whatever, something is going on there. Very serious kind of reorientation of the economy. Now, you could argue, well, that's because everybody else is producing and we're just the financier of the world. And there's some truth to that. So finance would go up in the U.S. simply because we are geographically a focus of finance for the whole world. It's kind of like London. You know, the English economy, the British economy cannot support London as a financial center because it's a world financial center. So I think the only way you could rescue these data from perdition is to say, okay, well, now the New York is kind of like London is to England, New York is to the U.S. And we're a shrinking productive economy, but we're still rule the world of finance and services or something. And people do argue that. And there's something to it. There's definitely something to it, but I don't think there's enough to it to explain what's been going on. And then finally the bubble bursts, and you get post-bubble depression, postpartum depressions. And there's a new book by a couple of relatively conservative economists, Ken Rogoff and Carmen Reinhart. Actually, she's the first author. And it's called This Time It's Different. And they go through 500 years of bubbles, and they look at it. But the problem with them is they kind of argue, well, it's bound to happen, and get used to it, and it's too bad, but now we've got to pick up the pieces. Because they aren't going to hook it to some fundamental dynamics of capitalism or the decline of the empire or anything like that. But what they do that's useful is they look at how hard it is to get out of these post-bubble collapses. That the worst depressions are always after big bubble collapses. Why? Because you can't get credit anymore. The credit system shrinks, it dries up, money shrinks, assets decline, so you get a reverse wealth effect. Everybody feels poorer. Industry is reluctant to invest because, and you get high unemployment. I should have added that in there. Consumers are all writing off, and companies too, writing down their debt. Oh, I got that. Consumers cut back. They're all paying off their debt. So they cut back on investment, they cut back on consumption, and of course government revenues are going down. So C plus G plus I are all going down, but they go down really sharply in these kind of collapses. And it's very much tied to a sense of getting poorer, of money shrinking, and the credit system shrinking, and assets value shrinking. So here's a chart that shows stock values going back to 1900, showing these kind of periods that are because kind of peaked in 1900, then it went pretty flat, or down. Actually, this shows that it's flat. Then another bubble in this would be 29, then a 10-year or so period. Then it starts going up, then we have a crappy 70s or 80 and early 80s, then it goes up, and then it craps out again. But this kind of chart, and this is just by some financial advisor, is arguing that after these kind of very sharp rises, you're going to get a dead period, which would correspond with what Rogoff and Reinhart are trying to say. Okay, so let's go through the history of it a little bit. Play it again, Sam, because this just goes over and over again. So if we go back to, I got 3 headings: tulips, tracks, and trouble. So that's kind of ancient history. And then I'm going to do the crises of the last 30 years, the bank blow-ups and the securities bubbles of the late 20th century. And then I'll go to the 2000s. Okay, so long history of bubbles. And one of the most famous of all is probably the tulip mania in Holland. Holland was at its peak in the 1600s. It hits in 1634 to 1637. There's the price of tulip bulbs. When you see grass like that, you know that you've got a cancer or you've got a melted down ecosystem, and this is the rats running amok, or whatever it happens to be. It could be reindeer, doesn't have to be rats. But then the second most famous is probably the South Sea Bubble. As Britain took over from Holland as a major financial center, they did this craziness in the 1720s called the South Sea Bubble. It was this investment in these big trading companies. There was the Dutch or the English East India Company, there's the Levant Company, the Americas Company, and somebody created a South Sea Company. But in the South Seas there's a few islands, and that didn't turn out to be a really great investment. But you'll see graphs of stocks later on from the 90s and so on that look remarkably like this graph. And paintings of these periods when guys are in the stock markets in London. And this, of course, people were paying these enormous prices for the fanciest new tulip. I think they just brought tulips in from, I think they originated in Iran or in the Caucasus, and they were brought into Holland. And this was a period, by the way, of improvement, because it's early capitalism. So you started getting systematic technical improvement in agriculture. So breeding of animals and plants starts to happen in a big way. The tulip thing, of course, is crazy because it's all about a pretty flower. But they're also, breeding Holsteins and stuff like that at this time. But there's never a Jersey cow bubble. Okay, the United States has a vigorous history of bubbles as well. Are you listening? You are? Okay. Starting in the 1830s, we had this huge canal boom. The whole Northeast got covered with canals, and so did parts of the South, which were all done through the issuing of state bonds, by the way. They weren't private. Most of them were public. And British investors gobbled up these silly bonds, and they built ridiculous canals over the Appalachians that could never pay themselves out. But it was all tied to the land boom out here in the Midwest, to the industrial boom in New England, and it all blows up in 1837, the Panic of 1837, triggered, by the way, by Andrew Jackson closing the first bank of the United States. And the U.S. goes into its first really modern depression in 1837 to 1843. Then the economy picks up again after that. The greatest boom, by the way, in American history is not post-World War II. It's the boom that happens after that depression, before the Civil War. Well, with the 50s, but especially the 1860s, the end of the Civil War, the economy takes off, capitalism is unleashed, and railroads are unleashed. And they start to build railroads every which way across the U.S. We get the modern New York Stock Exchange, which is mostly investing in railroad stocks. Philadelphia Stock Exchange also. In San Francisco, it was mining stocks because of the California gold and the Nevada silver rushes. Those blow up in the 1870s famously and lead to the greatest depression of the 19th century, the Depression of 1875 to 77. That's the depression when you get the Great Railway Strike, the first national strike. You get the Working Men's Party and the anti-Chinese movement in California, all triggered by this recession, which was really devastating, and mass unemployment. Nobody knows exactly how much because there's no data then, but probably well in the 20%. And then there's another bubble in the 80s, again with railroads, but also corporate stocks on the New York Stock Exchange. Industries are overexpanding, prices are falling, and there's a crisis breaks out in the mid-1890s, which also is a pretty significant one. And it's the one that actually leads to the creation of modern corporations through consolidation, to the creation of modern investment banks under J.P. Morgan, who are going to consolidate these corporations, partly to get prices up, partly to get greater efficiency and get productivity up. But a lot of it was, at first, to get prices up because they've been falling in this period in the 1880s very badly. And then, in, of course, the 20th century, we get the great New York Stock Exchange bubble here, which shows up pretty dramatically. This chart only goes to 2001. This, again, is price-earnings ratios. This one argues that 29 was the worst of the whole century. No, I guess this only starts in 71. So, is that right? No, wait a second, 1871. So the worst one of the whole modern period, post-Civil War period. And along with it, by the way, there was a huge stock bubble in L.A. with oil stocks. The whole book on that, the Julian Petroleum Scandal, it's called, in L.A. history. The great Florida land bubble that created Miami Beach and platted millions of acres of swampland, which should remain swampland to this day, but haven't. And then we start to see other bubbles like the post-war era, although it wasn't very frothy. You did see in that long-term chart, and here it shows up again, there is a rise in the stock market from the 50s to the early 70s. There is a real estate bubble in the late 60s, early 70s, at the end of that great post-war building boom. There's a lot of bank lending, over-lending, and there is a crash. There is a real come down in 73, 75 that takes down a bunch of banks. Continental Illinois Bank fails in that one. A big bank in Oklahoma failed, name of which escapes me. The Pennsylvania New York Central Railroads failed in that. New York City failed. That all happens in this crisis. And that crisis is always explained as being caused by oil prices and OPEC, but that's not true. If you look at this graph, you can see there are these long waves of financial speculation, and there's one that collapses. It has nothing to do with OPEC. We'll talk more about OPEC on another lecture, if they aren't all canceled by future strikes. And that brings us, and then I'll throw in some European bubbles. Britain is a little weird. I was trying to come up with some charts and some better information, because I know there's a couple of bubbles in the 1840s, and Britain has a big recession in the late 1830s, 40s, kind of like the U.S., but not quite the same time, at the end of the great post-Napoleonic textile bubble. It then leads to a lot of social unrest, the Chartist movement, the anti-corn law reform movement, which ultimately opens up free trade. And this is the time when Ricardo is writing about and also J.S. Mill, is accumulation going to run down because of falling profits? They're worried about falling rate of profit. Ricardo's worried about agricultural rents because food prices are very high because the national market is restricted. So they open the market and flood Britain with cheap food, which destroys Ireland, because Ireland had a protected market, and that leads to the famine and the exodus of roughly 4 million, the death of 2 million, and exodus of another 2 million Irish over the next 10 years or so. Absolute disaster for Ireland. Even better example, though, is Second Empire France. We do know more about that. It's written up more. And that's Haussmann's Paris, the great building boom when Paris is torn down and rebuilt by this guy Haussmann under Napoleon III, who was a dictator for 20 years. The boom starts in 1850, and it comes down. It's starting to go into crisis in the late 1860s. There's this great Credit Mobilier and Credit Foncier that are some of the modern banks ever created on the continent of Europe, and they're financing the rebuilding of Paris. This is an old picture of knocking down Paris, rebuilding it. That's Manchester, by the way, in the 1830s. And it all blows up in Haussmann's face. He's thrown out. Social unrest. Napoleon III is thrown out, and you get the Paris Commune, one of the great revolutions of modern times. And it's also complicated by the Franco-Prussian War. So that's pretty dramatic, too. But the collapse of Haussmann's Paris is not just because the Prussians invaded. It's because of the blow-up of the financial bubble. It took France a long time to recover from that. Okay, so how about our times? Things have been going pretty great. So we get that real estate bubble crisis in the early 70s I talked about. But then the 70s takes off again. What happens? Well, two things happen that are noted besides the fact that the real economy starts to recover. And one is that all this money that's being made by OPEC, as OPEC prices have gone up, and all these Saudis and all are sitting on piles of money, they're recycling it through the London and New York banks, what's called petrodollars. And that money is then being lent out around the world. So some of these banks are sitting on piles of new money, which they lend held a leather very friskily all over the world without paying too much attention to creditworthiness. Also in the 70s, especially in the U.S., you get price inflation, partly because of loose money, and partly because of corporate strategies to try of raising prices to try to get their profits up. Because remember, corporate profits have fallen from the late 60s through the mid-70s. That's a major trigger of that crisis. And so you get a weird thing of a high inflation and low real interest rates, where at times the interest rate is actually negative, and people are borrowing like crazy because it doesn't cost you anything. So there's this mad frenzy of borrowing and lending goes on in the 70s, gets the U.S. bank system really bloated up, gets the World Bank system bloated up, and then it all comes crashing down in the early 80s. This is when, if you're in development studies or political economy, you learn about the great defaults, national defaults of around 1982, 1984. Mexico, Brazil, and Poland are the biggest, but there's some others default at that time. What you don't hear about is how that connects to U.S. bank collapses. We have another bank crisis. Bank of America almost goes under, barely saves itself. Crocker Bank, which was the third biggest bank in San Francisco, goes under. And a whole series of other banks go under across the country. All linked to real estate speculation, overseas investments, and farm lending. And this is when, if you're interested in agriculture, people who know about agriculture know of the farm crisis of the early 80s. And it's all blamed on Russian demand and prices went up. Yeah, and the farmers got all excited. That's true. But the banks start throwing money out. And everybody's getting deeper in debt. Buy bigger equipment. Expand your land holdings. Buy out your neighbor. And poof, it collapses. And that is really the last gasp of the small family farm in America when that collapse takes place. And bank profits, by the way, if you look at this chart, bank profits collapsed in the late 70s, early 80s. Now, what also happens is monetary policy. Paul Volcker, who was appointed by Carter, actually, is the head of the Fed. He's the guy before Greenspan. He decides he's a conservative banker. Now he looks kind of radical compared to Greenspan. But he was going to squeeze inflation out of his economy. He was going to squeeze the speculative bubble out. So he clamps onto the interest rates. He drives interest rates up to extraordinarily high real interest rates, getting close to 10%. Companies, banks all start going under. The deindustrialization wave of the early 80s that you've heard about isn't just because of Japanese competition or Korean steel mills. It's also because these companies go belly up because they can't pay their debts. Because they're taking out a lot of bank loans, the bank interest rate goes up, and they're screwed. So that also causes the great deindustrialization wave. It's linked to finance. And then comes the S&L crisis of the 80s. Okay, we ring out the banks, but there's this one subgroup of banks called savings and loans that have been sitting around for a long time, that have been reformed by the New Deal. Very, very conservative. They're supposed to take in local savings, lend locally to local neighborhoods for housing, low interest rates, and they really work. They recycled through local neighborhoods, local towns, and so on. Well, in the 70s, you get all this fast money, the invention of the money market fund. People pull all their money out of savings and loans, and I remember this, kind of going, what the hell? For years, your lousy savings account was all you had, because little people like me didn't invest in the stock market. So you just put your money in the bank and you got 2.25%. Suddenly, people you knew were getting 6.5%. Because they shifted their money into these money market funds, which out of the blue are earning these huge interest rates. Where the hell did that come from? Well, it all has to do with high interest rates and the rise of global financialization, really, of the global possibilities of investment, and of course the general kind of high nominal interest rates, or low, high investment possibilities that were opening up around the world. So that sucked money out of the S&Ls. So then the S&Ls go to Washington and say, oh my God, we're going to die. All the money's leaving. Let us play this game. So they deregulate the S&Ls so that the S&Ls can pay high interest rates. They can issue CDs. Oh, that's right. The banks also invent the CD, which didn't exist, which offers a higher interest rate than the savings and loans. So the savings and loans, let us do it. Let us offer huge CDs of $100,000. Let us invest in speculative real estate anywhere we want. So they said, okay, go ahead and do that. What happened? A bunch of scam artists like Charles Keating got in, ran these S&Ls, made them in huge piles of money, and then ran them into the ground, and they all collapsed from the late sort of 1987 to 1990. And $300 billion, which at that time everybody thought was a lot of money, vaporized, and the government had to step in and issue credits for $300 billion to holders of CDs and holders of stocks and S&Ls. And they bail out the S&Ls and then sell the S&Ls off, which, by the way, helps build the mega national banks we already talked about. They just buy these S&Ls all over. The government says, yeah, we want to get rid of them, so if you become a multi-state bank, that's fine. We're going to let that happen anyway. The Japanese, of course, have their own unbelievable bank bubble and land bubble of the 80s. The banks are lending at these low, steady interest rates for their old buddies like they've always been doing, but they forget that suddenly there's a bubble develops in Japan. The value of the yen goes shooting up. Land in Japan just becomes crazy expensive. Tokyo becomes worth more than all of the United States. The land on which the Imperial Palace stands in the heart of Tokyo becomes worth more than all of California. And you think, this is not right. And indeed it wasn't. It blew out. Here's the real estate bubble. And there's another one of those Mount Fuji kind of graphs that are not healthy. And by the way, Mount Fuji is eroding pretty fast in geologic terms, right? And there's the Japanese stock market. Actually, the stock market was less important than the land market. That's where the big bucks were and where the real crisis hit. Okay, so Japan blows up in 89, takes it another decade to recover. And everybody today now says, the United States, we're going to be like Japan in the 90s. Why? Because we had a huge financial blow-up, just like Japan, and we're likely to have 10 lousy years. And indeed, we're about 4 years into those 10 lousy years, depending on when you start counting the decline in the 2000s, whether it was from the peak in 2006 or whether it was from the blow-up in 2008. We're well into that. Then there's also a stock market bubble in the 2008s and the 80s, and I didn't know where to put this, so I put it in the 80s. Just remember that that's when Tom Wolfe writes Bonfire of the Vanities. That's when the name Gordon Gekko gets known. That's where the first movie comes from about the Masters of the Universe and all that. That's when Ivan Besky comes up with that great American slogan of the late 2000s, greed is good. It's even better than the business of America's business, as Calvin Coolidge so aptly said in the 20s. And that is absolutely the mantra of our time, greed is good. Besky, of course, ended up in jail, so it didn't work out too well for him. And you get this incredible 86 collapse in the New York Stock Exchange, which I think is still the biggest collapse in one day. I think it even tops 1929, Black Friday. Because of a computer, they started computer trading in the 80s. The computers all jump on the bandwagon as it's going down, which nobody had programmed them to say, if it falls 100 points, stop. It just kept going down until they pulled the plug. The New York Stock Exchange just finally just pulled out the cords and said, no more trading until Monday or whatever it was. I forget if it was a Monday or Friday or what it was. Well, it turns out that was just the beginning. So now we'll go into the securities bubbles of the 90s, which are even bigger. I mean, this whole thing is you couldn't make this shit up, right? If you think something isn't wrong, you just have to learn a little modest amount of history. Well, yes. Is it possible this is going to stop happening? God only knows. If you don't slap on some pretty severe regulations, it's not going to happen. That's number one. If the U.S. economy doesn't revive, it's not going to happen either. So we'll see. A lot of conditions. Anyway, so you start getting these geographically rolling asset bubbles. Remember I talked about international portfolio investment? The security